Welcome to the opening interview of the Gold Summit. As the theme for this year's interviews, we asked each of our guests what the top catalyst for gold would be in 2025. Not many could contain themselves to just one reason why gold will surge, and our first interview is a good example. Over the past 15 years, Ronald-Peter Stoeferle has become the world's leading gold commentator. He first shot into the headlines in 2007 when he forecast the price of gold would rise to $2,300 an ounce. Back then, the price was only $500. His widely celebrated free annual report called In Gold We Trust has since become the gold investor's Bible. It regularly draws international coverage from the likes of CNBC, Bloomberg, the Wall Street Journal, and the Financial Times, not to mention a huge number of downloads from professional and novice investors all around the world. Ronnie also manages several funds for investors at Incrementum AG in Liechtenstein. In this interview, Ronnie argues that gold remains undervalued despite the 2024 breakout to new all-time highs. He also claims that investors will need a new playbook to understand why gold is rising in 2025. To find out what's really driving gold, over to our host, Nick Hubble and Ronnie Stoeferle in the studio.
Ronnie, thanks very much for joining us from Liechtenstein, although I must say I'm surprised you're not yet in your beloved Austrian Alps given the early snow.
Yes, but I already really look forward to hitting the slopes finally. It's been way too long.
Is it going to be a good season? You're going to be on the record here.
Every season is a good season. Just gotta make the best out of it and chase the snow. So yeah, I'm pretty excited for the upcoming winter.
Yeah, I've been skiing in Austria a few times because my mum lived there, and I must have fallen about 20 times on the Hahnenkamm.
Yeah, okay, but you're in good company.
Yeah, very good company.
This is like
all right.
The toughest, the toughest rides that you can have in the Alps. So that the famous Streif is that's really the top of the pops. So it cannot get any better, but also more dangerous.
Yeah, well, I wasn't going very fast, I can tell you that. All right. So your catalyst for gold in 2025 is a very simple one at heart. It's just the idea that gold remains undervalued despite the fact that we've had this blowout year in 2024. And you've got lots of reasons for that, which we'll go through. The key one to me is that the gold world has changed. There's this new playbook. Before we get into what's driving the new playbook, I want to ask you about what's changed for the old one, the death of the old paradigm, the death of the old playbook. Take us through what's changed for gold investors.
Well, I think it's the major topic that people completely underestimate is the enormous amount of gold demand coming from emerging markets. And that's a trend that's going on for quite a while. But now I think that emerging market investors, and that's not only the retail investors, but also central banks from emerging markets, they are now really the marginal buyers. So they're definitely more important than Western financial players.
What about this decoupling from interest rates that sort of shocked and confused everyone this year? Take us through this wonderful chart you have that you've sent over about the way the 10-year tips yield and the gold price have suddenly diverged since, 2023?
Yeah, I mean, actually already slightly earlier, I would say like 2022. So Nick, usually real interest rates are really one of the most important drivers for the price of gold. So usually when we see rising real interest rates, that's a big headwind for gold. So the opportunity costs are rising. Gold doesn't pay any interest, obviously, and therefore rising real rates are usually, according to the old playbook, one of the most important negative drivers. Now, what is remarkable is that we have seen gold in a major bull market and making new all-time highs in an environment in which, according to the old playbook, the gold price should actually have fallen. So in the old playbook, it was completely unthinkable that the gold price would trend firmer during a phase of sharply rising real interest rates. So we know that not only nominal rates were rising significantly, but also inflation numbers were coming down. And in the old playbook, again, this would have been massive headwinds for the price of gold. And this is quite telling, and it tells me that the rules in the gold world have completely reversed.
What reversed them? What's the change?
Well, I think it's primarily, as I said before, it is this enormous amount of demand coming from emerging markets. So I would say that the first chapter of this new gold playbook is actually the fact that central banks have become a major driver on the demand side. So we're seeing that since 2022, and this is the time when Russia invaded the Ukraine, and when the US and the EU have implemented those sanctions against Russia. That was definitely a wake-up call for many other countries, and therefore it's no coincidence that this really started in 2022, and since then we're seeing that central banks are buying roughly 30% of global annual gold production. So this is really that's truly a major driver on the demand side. And the second thing is obviously that I would say that we are therefore to some degree experiencing a renaissance of gold as a central bank asset. So we saw that in the 1980s, early 1980s, for example, the share of gold of total monetary reserves in central banks was roughly 75%. So at the moment, we are roughly at 17 to 18%. So will we go back to those levels from the late 1970s, early 1980s? Probably not, but I think it could easily double going forward. So this is, I made the analogy with the world of professional wrestling, where there's the so-called heel and the face, so the bad guy and the good guy. And I think we're seeing such a heel turn in the gold world, where it is now becoming, it used to be over the last basically 40 years, it has been like the bad guy. Nobody really wanted to hold gold as a central bank reserve asset. And now we're seeing this turn where gold is now really becoming the neutral monetary reserve asset again. And this is, again, it's primarily being driven by central bank demand from emerging markets.
You mentioned the Russian sanctions story. That's the sort of the latest example of this central bank buying, something that we've talked about with some of the other guests on the Gold Summit. It's the first one I'd like to get into with you, which is the financial crisis, the period after the financial crisis. The gold selling turned to buying around then from central banks, according to these excellent charts that you create. Take us through that period as well, because I think viewers are aware of the Russian sanction story, but they haven't yet heard about that financial crisis story.
Yeah. Well, I mean, we shouldn't forget, Nick, that during the 1990s and actually up until the year 2009, central banks were actually net sellers. So we all know about this the famous or infamous brown bottom where Gordon Brown back then sold I think almost 400 tons of physical gold, basically at the bottom of this brutal bear market in gold. And we also saw Switzerland selling 1,300 tons of gold. Austria was selling gold. So actually that was really the time when nobody really cared about holding gold as a monetary reserve asset. So back then, we saw that up to 29% of annual mine production was actually being sold by the central bank. So it was an additional supply to the gold market. Now, this has changed with the great financial crisis. And why has it changed? Primarily, from my point of view, because we went for the very first time to zero interest rates, to negative interest rates, even in some countries. And the Federal Reserve came up with a very something new, a sophisticated term called quantitative easing. Now, many people would say that's actually money printing. And I think this was really the turn the turning point for central bank demand, where on the one hand, central banks from the Western world stopped selling their gold. And then on the other hand, many central banks from emerging markets, primarily Asia, slowly but surely started buying gold. So this was the trend, I would say, after the great financial crisis until 2021. But then we reached another stage with the implementation of the sanctions against Russia. So there are different stages. It doesn't necessarily mean that we will go, we can't go back to central bank net selling. I don't see it coming yet. But I think the important thing is that there's quite a lot of central banks, not only in Asia, but also, for example, Hungary, Poland, the Czech Republic, that have implemented strategic gold buying programs. And those programs, they are usually not extremely price sensitive. And once they're implemented, they stay around for a number of years.
Becomes a bureaucratic program. And also they're, of course, repatriating a lot of gold.
Yes. So that's another sign of, I would say, some sort of a distrust or crumbling trust in geopolitical alliances. I think it's a sign of, you know, this deglobalization that we're seeing now in all sorts of parts of our lives, actually. And I mean, let's face it, we've been pretty busy tearing down walls for the last 30 years, and it now seems as if we would be building new walls with, you know, all the tariffs that are being discussed, new alliances coming up, and actually the world breaking up into basically at least two different blocks. And I think that gold could be some sort of a monetary tool of communication, basically, between those blocks. Because, I mean, let's face it, it's traded 24/7. It has a very long tradition. It has a very sophisticated infrastructure of trading all over the globe. It doesn't have any counterparty risk. And those are the main reasons why I think that gold is really coming back as a neutral monetary reserve asset.
Yeah, that counterparty risk point is only true if you've got it in your hand, which is hence the reason for the repatriation.
Yes.
Let's move on to bonds, which is the story I'm most interested in. You've got this wonderful chart showing that bond returns are negative now for the last 10 years on US tips. But there's a lot more to the story than just a simple bond story. So take us through how bonds are no longer going to be the knee-jerk safe haven and how gold might replace it.
Yeah, I mean, I at one of my recent keynotes, I started with some pictures from the year 1980, and that was like ABBA came out with Super Trooper. We saw Star Wars: The Empire Strikes Back in theaters. Jimmy Carter was handing over to Ronald Reagan. Everybody was smoking on a plane. So it feels like, centuries ago. But actually, 1980 was the year when the last big bond bear market actually ended. And since then, Nick, we basically moved into a market landscape where bonds have almost reflexively been seen as safe haven. So we've all become conditioned, like Pavlovian dogs, to rush into bonds at any sign of economic weakness without factoring in potential inflation risks. So from my point of view, we are in, I wouldn't say that the very earliest stage, but we're like in the middle of a big bond bear market, and many people haven't realized that really. And I think that's like a major part of our new gold playbook, the fact that government bonds are no longer the anti-fragile portfolio foundation that they have been basically for the last 40 years. So we know that in 2020, that was basically the double whammy for every balanced portfolio, because it was the time when not only stocks but also bonds faced massive losses. So in 2020, basically when yields reached its lowest levels, or bond prices their highest levels, back then from peak to trough, 10-year treasuries fell by almost 30%, while the 30-year bonds fell 49% from their peak. But I think, and this is a chart that we're showing, that with the 10-year annual inflation adjusted performance of 10-year treasuries, it seems that many market participants have not realized that, actually, and this is primarily, obviously, institutional players. But according to our analysis, and Nick, you know that we really try to understand the big picture, so all of our charts are really long-term charts. Based on the 3 previous big bond bear markets, those market conditions can last for more than 10 years, and now we've only seen like 2.5 years with negative 10-year annualized inflation adjusted performances being in negative territory. So I think this could be really one of the most important drivers for gold going forward. The fact that actually bonds could hand over to gold as a kind of an anti-fragile portfolio foundation. And this is actually something that in the Western world it still is an outrageous call. But then on the other hand, why is it that crazy? Primarily because we haven't seen any inflation or inflation volatility since this so-called Great Moderation. And even now, with inflation breaking out in the year 2022, I think the majority of market participants thinks that, now inflation is under control again. We'll go back to the old narrative, to the old paradigm. I don't think so. I think that at least one more inflationary wave is on the horizon. This will probably be the trigger for the next stage of this bear market in bonds.
It all depends on how long your memory goes back, right? Because gold used to be the bedrock of the financial system, the currency system, the banking system. It became bonds, and everyone sort of presumes now that it was always that way, that the bonds backed everything, that they were the safe asset on bank balance sheets, they were the safe asset on central bank balance sheets. But gold used to play that role. So is this just a return to normality?
Yeah, I would say so, actually, Nick. I would say that let's put it, this big market shift that I think many people have already kind of realized, but still the larger the institution is and the more bureaucratic the institution is, the more they stick to the old gold playbook. And there's only very few asset managers that have this flexibility to actually quickly change into a new paradigm. So therefore, I think in the end of the 1970s, beginning of the 1980s, debts were called or bonds were called certificates of confiscation. Actually, the US had to issue bonds denominated not in US dollars, but also in Swiss francs and Deutschmark, because nobody really trusted the US dollar anymore. After this highly inflationary or stagflationary decade of the 1970s. Now, history won't repeat like 100%, but it will rhyme from my point of view. And again, I think that we've all been so conditioned during the last big episode of 4 decades of falling inflation and falling inflation volatility and pretty little macro instability, that there's very, very few market participants and market, let's say, practitioners actually in the asset management industry that actually had to navigate through an environment of high inflation, volatility. I would, if we come back to skiing, perhaps, it's like, when you've got great weather and, the sun is shining and you've got fresh snow, everybody is a good skier, even the Dutch. But then when it's icy, when it's foggy, when you've got poor weather conditions, then you can really differentiate who's a good skier and who's not. So I would say the next couple of years will probably be heavily influenced by more macro instability. I think inflation will be one of the major drivers going forward, and we should also expect more financial repression, and therefore I think adapting to this new gold playbook that we have described, and it's not only about gold, it's also about real assets in general. I think that's really crucial for the scenarios that we've got in mind.
Yeah, as Russell Napier says, we should have wealth managers that have been living in places like Argentina and South Africa. I want to highlight this chart that you've got, although we mentioned it briefly earlier, about the correlation between stocks and bonds. Because for many decades now, if you visit a wealth manager, they'll try and sell you their version of the 60-40 portfolio. And the presumption of that working was that stocks and bonds are negatively correlated, which according to the history that they might have shown you has been true since about the year 2000. And your point is that we're entering a period where that may no longer be true. And so as a result of that, we go to the next chart. You argue that the new 60-40 portfolio should include a whole bunch of other things that previously weren't there. The implicit point you're making, I think, is that a whole load of money is going to come flooding out of bonds and into gold. Is that accurate?
Not only into gold, but I think, Nick, it's interesting to see that actually everybody takes this negative correlation between stocks and bonds for granted. So this is basically the foundation of the 60-40 portfolio, that once it gets a little bit wobbly in the equity markets, bonds will actually save your returns. But actually, we crunched the numbers, and the correlation between stocks and bonds in the US has been slightly positive in 70 of the last 100 years. And of course, the decisive factor for this negative correlation of the last couple of years was this low inflationary pressure that we've seen, and this decreasing inflation volatility. Now, if the historic relationship between stocks and bonds should reverse permanently, we have seen over the last couple of years actually a positive correlation, then I think that bonds will not be, the portfolio hedge, the portfolio diversifier that they have been. So this was the reason why we came up with this new 60-40 portfolio. And I think, Nick, it's important because gold and equities are often being regarded as like the enemies. But from my point of view, the real competitor of bonds of gold is actually bonds. So from our point of view, obviously there has to be a large allocation to equities. But where we would say that's like really the major change for and that's of course a rule of thumb idea and suggestion. We would say that instead of 40% bonds over the next couple of years, roughly 15% gold are more advisable. And from this 15%, I would say the allocation to corporate debt from really good and solid companies, as well as emerging market debt, should be significantly higher than to many traditional safe issues from the Western world. So this is like the major change. And I think that gold could definitely take some market share from the bond market. And I mean, let's face it, bonds still have a valuation of more than 90 trillion US dollars, while gold at the moment is at roughly 18 trillion. So if there's like just a small reallocation, that would definitely have a major impact on the gold market.
Would you include banks, pension funds, and other institutions in that transition, perhaps even the regulatory system acknowledging the role of gold? Or do you think those institutions will be pressured into holding bonds indefinitely?
Yeah, well, I mean, that's the financial repression that I mentioned. That's this will definitely funnel money or capital into directions where it would naturally not go to. That's a bit like regulating, a river or a stream into one direction. And I think that this should create artificial demand for government debt. Absolutely. From a legal point of view, just as an insight, how it already works for us, for example, within the UCITS fund, it's not possible, it's not allowed to hold any physical gold. We can hold some gold ETFs, we can hold structured products and so on, but within UCITS, physical gold is not allowed, while taking an enormous amount of leverage on sovereign debt is, for example, perfectly fine. So this is already happening, and I would say that there will be a point when actually pressure will be very high on pension funds. But usually, the larger they are, the more bureaucratic they are, and therefore the longer it takes to really make a major shift in allocation. We haven't seen that yet, obviously. But then at the beginning of the 1980s, for example, in the institutional world, there was roughly 18% of total assets under management were allocated in gold. So will we go back to that level? No, probably not. But I think we're coming from a very, very low level. So there's many different numbers, but I would say that below 1% is actually allocated in the Western institutional world in gold. So if that doubles or triples, that would already be an enormous stimulus for gold demand. And I think at some point this will happen.
It might echo the adoption of Bitcoin by Wall Street over the last few years in so many different ways. But let's move on to the Eastern demand for gold, which is the third and the final catalyst that I think is part of this. I remember the days when these new trading platforms were setting up in Asia and the Shanghai Gold Exchange and so on and so forth. And people like you were saying that this would radically change the demand function for gold, leading to the gold price to rise. That started to happen very much. I think you're arguing it's just going to continue or to accelerate. So make that case for us.
Yes, I think we're sometimes a little bit arrogant in the Western world, and we think that we still mainly influence the gold price and gold demand. But then let's face it, that's nothing new. It's a long trend already that gold demand is shifting east. And as I said at the beginning, emerging market investors are now the marginal buyers. So to quantify this significant impact of gold demand in Asia, last year 65% of total physical jewelry demand came from China, India, and the Mid East. If you add in some other countries like Turkey, Indonesia, Vietnam, for example, you will end up at like 75, almost 80% of physical gold jewelry demand coming from emerging markets. When it comes to the physical gold bar and coin demand, China, India, and the Mid East are responsible for more than 50% of total demand. So I think it's important, Nick. I think the Western media will always claim that the current gold price is mainly is rising due to geopolitical tensions and fear of unsustainable US deficit. But I think it's important to ask the question if it's not primarily being driven by the forces of Eastern emerging market physical demand. So I think that gold is primarily being driven by Asians' love for gold. I think that's an important driver. Now, my friend Louis and Gaff said gold is a low beta emerging market proxy. Now, what does it mean? It means that actually with this very strong cultural affinity for gold, we will probably see rising gold demand from emerging markets with growing populations and also increasing GDP per capita, pretty high savings ratios. So therefore, I would say, if you're bullish on emerging markets, you should also be bullish on gold demand from emerging markets. And you just have to travel to Dubai, to Shanghai, to India to really experience and to see how important gold is in those countries and in those cultures, and how much more important it is compared to the Western world. And we made a special analysis on the optimal gold allocation. So how much gold should you actually have in your portfolio? And we came out with the conclusion that actually, based on the Sharpe ratio, the optimum is achieved in an allocation range of roughly 14 to 18%. So 14 to 18% physical gold in your portfolio, this really improves the characteristics of an equity bond portfolio. Now, if I say that in the Western world, people say, you're crazy, this is way too much. But when I say that at a keynote in Turkey, for example, or in India or in China, people will say, you're crazy, that's way too low. So this shows this divergence that we are having, when it comes to this natural gold affinity in the Western world versus emerging markets. It's really completely the opposite.
And Western investors are learning the lessons that come very intuitively to people in places like Turkey and China about inflation and trusting governments and that sort of thing. The proof is in the pudding with this chart that shows that returns have been occurring during Asian trading hours in gold. Take us through the chart, please.
Yeah, well, that's a great chart coming from the World Gold Council. Johann Paulberg put that out. It shows the 20-minute intraday spot gold cumulative returns divided into regional trading sessions. That sounds a little bit complicated, but it shows you actually, and it confirms actually what we're saying. So that the majority of returns is now being made during Asian trading sessions, while more volatility is actually happening in US sessions. And I think that's a perfect example, and it also is confirmed by the enormous rise in volumes and importance of the Shanghai Gold Exchange, for example, which has always been kind of ridiculed, but is now really becoming a major driver. So I think the gold infrastructure in emerging markets is becoming more and more sophisticated. Is becoming more professional, and the trading volumes are rising, and therefore I think that LBMA and COMEX are also clearly losing market share. And I think if you go back in history, you can see that gold always goes where the money is, where prosperity is, where savings rates are high, where economic momentum is, and now obviously it's flowing into emerging markets.
You are famous for making some pretty precise predictions about the gold price. You've made one recently about the price for 2030, and I mean it's especially worth mentioning given how accurate your prediction for this year has proven to be based on last year's prediction. So take us through the two, please.
Yeah. Well, I mean, we calculating price targets is always difficult. And I started my career as an equity analyst. So I know that, the majority of market participants, they've got a very hard time actually valuing gold because there's no cash flow. You cannot do any DCF modeling and so on. But from our point of view, gold is not a commodity. Gold is obviously doesn't have any cash flow, but it is a monetary asset. And therefore, we came up with a monetary model and described that in our 2020 In Gold We Trust report, and back then said that our long-term price target is $4,800 by the end of this decade, so in 2030. And based on that model, we are really right on track. So we said if we really stick on that path, then the price of gold should be 2,660 by the end of the year 2024. Now, the other price target that we gave, and we've been the most accurate analysts on Bloomberg actually, was 2,700 US dollars. And that was a purely technical target, because we said there's this large 4-year consolidation pattern, which was basically the consolidation of this large cup and handle formation. And once we break out from that target, the so-called measured move is 2,700 US dollars, and we've perfectly achieved that. So the question is, where from now? And that's really where it gets obviously interesting, for us as asset allocators, and also for the viewers. And my take would be that we're somewhere at halftime in this gold bull market. And we've got a couple of slides about that. I think now at the moment we're taking a breather, a healthy breather. But I think this bull market is definitely not over. And I think that there's a number of drivers, and we can, I think we discussed already some of those drivers, those structural drivers. But I think going forward, there will be some additional drivers for the price of gold.
So take us through your work at Incrementum, the In Gold We Trust report. How can people follow you as this gold bull market continues?
Yeah, well, I mean, we're asset managers based in Liechtenstein. We're managing 6 funds at the moment. The majority of them, I would say, in the real asset space. We focus on commodities. We focus on precious metals, but we've also got funds that combine gold and Bitcoin. Now, I know that many people in the gold world don't like Bitcoin, and I know many people in the Bitcoin industry that hate gold. But from our point of view, it makes sense to combine the both. So this is our asset management side, and I think it's important to really also mention that's a big difference actually to many other forecasters, that we've got products and we're managing assets, and actually there's the proof in our daily net asset values if we're doing a good job or not. So this is the asset management side, and the other part of our business and what I'm doing is the In Gold We Trust report. So I'm publishing that report for 18 years now. It's a pretty extensive publication, so more than 400 pages. There's also a compact version, obviously. We do monthly chart books. We have got special publications. And the beauty of it is you can download everything totally free of charge on our webpage, ingoldwetrust.report.
It's literally the Bible of the gold investor these days. Nobody does it better than you, Ronnie. Thanks very much for taking the time to come on. I'm guessing that because it's a UCITS fund that you have at Incrementum, it's completely accessible to investors in the UK?
Yes, absolutely. We can basically investors from all over the globe, but one country, the United States, can invest in our funds. So so sorry about that, but it's a regulation, unfortunately. Yeah. All information about our funds is available on our webpage, incrementum.li.
So if you've enjoyed this video at home, please do check out Incrementum as well. Thanks very much for joining us.
Thank you very much for having me, Nick. It was a great pleasure. Thanks.